We will get started. So welcome everyone to today's webinar. Very good morning, afternoon, evening, depending on where you are. My name is Ishita Sen. I'm an assistant professor at Harvard Business School in the Finance Unit, and I co-organize these webinars as part of the Young Scholar webinar series on climate change, macroeconomics, and finance. It's organized by the E-Access Forum. And thanks so much for coming in and participating today, as well as in our prior Young Scholar webinars. And thanks so much for making it such a big success. So let me introduce with that our speaker today. So we're very fortunate to have Jan Starmans present his fascinating research. So Jan is an assistant professor at Stockholm School of Economics in the Department of Finance. His research interests lie in corporate finance and sustainable finance, contract theory, and search theory. And he's also an associate editor at the Review of Finance and received his PhD from the London Business School. So Jan's going to present his paper called The Pace of Change, Socially Responsible Investing in Private Markets. It's joint work with Diksha Gupta, who's at Johns Hopkins, and Alexander Popitova at Rochester. So without any further delays, Jan, thank you so much for agreeing to present. We're really excited to have you. The floor is all yours. And just before we get started, I would just ask all the participants if they have any questions. So please feel free to post them in the chat, and we will get to the Q&A part at the end. Jan, with that, the floor is all yours.
Perfect. Well, let me share my slides and then jump right in. Can you see my slides?
Yep.
Perfect. Well, let me say thank you, first of all, for the invitation. Thank you, Ishita, for hosting this particular webinar, and of course, thank you to the whole team in the background of the E-Access Forum for organizing this webinar. Now, the people working in this field know this field is moving very fast, and there are new papers coming out, and they're changing at a significant pace. So it's hard to keep up of kind of what's happening, and I think these types of opportunities are great to kind of exchange ideas and see where this is going, and also kind of get comments and views from a set of diverse people out there. And I really look forward to hearing what people in the audience have to say about this or about the topic more broadly. All right, so let me jump in and tell you about this paper. So it's called The Pace of Change: Socially Responsible Investing in Private Markets. And Ishita has already mentioned my co-authors, Diksha and Alexander. So as you can see, I'll sort of explain how these different pieces come in. So there's the pace of change that will be very important in this paper. There will be social responsible investing, sustainable finance, and private markets is the focus of this paper, and I'll explain why that is and how we think about private markets and also argue why this is important. But let me motivate this piece in a little bit more detail. I'm just hiding the panel in the background so I can see my own slides at least. So I don't have to convince anybody in the audience that there's something happening in this in the markets at the moment, which is quite staggering, I think. So there's this dramatic growth in social responsible investing. People disagree on the numbers quite a bit, but I think everybody who talks also to people in the industry will know that something is changing, and this topic of sustainability and climate change in particular is on everybody's mind and very high on the agenda, really across the board in all sorts of financial institutions. Now, if we think about the literature, in particular the theoretical literature, so there's going to be a theoretical piece, then the current focus in the literature is really on the question of how investors can generate impact, right? So there's some very influential research that thinks about, if you're an investor, what should you do? Should you divest? Should you engage? What are kind of the trade-offs? What is the advantage and disadvantage of each of these practices? And there's by now kind of a growing literature. I wouldn't say it's sizable. I think it's still very small, but there's a literature that speaks to these questions. Now, what's going to be the focus of this paper, and the question that we ask, is how quickly investors can generate impact. So that comes back to this first piece of the title, which is the pace of change, right? So it's really not just whether and how socially responsible investors can generate impact, but how quickly they can do so. And of course, in light of climate change, it's kind of obvious that that's an important dimension, right? So we don't need to sort of only figure out that, whether and how at some point, maybe in the far future, investors can maybe make a difference, but that has to happen quickly. And that's really the focus of this paper, thinking about time. So what we do in this paper, how do we achieve this? How do we go on about this question? We introduce pro-social preferences into an otherwise really standard dynamic search model. So it's a dynamic search model of financial markets. So the ingredients are very simple, and you will see it's a very standardized model. There's going to be an entrepreneur, and this entrepreneur owns what we initially call a dirty firm. So that's a high externality type firm. And this entrepreneur can, in fact, immediately reform this firm. Reform here means just reducing the amount of externalities. The entrepreneur can also, independent of this decision, search for an investor in this search market, right? So why search? So this speaks to this last piece, which is private markets, right? So we're really not thinking about like public market equity investing. We're really think about like private equity impact investing. That's really what this is going to be about. So we have to have a frictional market. So the entrepreneur can search for an investor and sell this firm to an investor out there. And we're going to think about a market where there are socially responsible investors in this market. So think about, as I said, impact private equity firms that are willing to reform such a firm if it's still dirty after an acquisition, right? So this is generating. So this setup, and I'll of course tell you more about the details in a minute, allows us to study the timeliness of reform. Why is that? The reform in this framework can happen at different points in time, right? So ideally, the entrepreneur would just immediately reform it in the first period, at the beginning of time. But of course, the entrepreneur may not, and then sell it to an investor. And because there's search frictions, this may take time. So socially responsible investors may acquire and then reform the firm. But this is going to happen at a later point in time, right? So clearly here, it's really preferable that the entrepreneur just immediately reforms the firm. So the question we're asking is how the presence of socially responsible investors in this market affects the reform incentives of this entrepreneur in this market. So whether the entrepreneur reforms the firm or not. That's going to be the key question. And that's going to tell us whether it's going to take no time, which is the entrepreneur reforms the firm, or it's going to take a lot of time, which is the entrepreneur doesn't reform the firm and some investor has to kind of take it over and reform. So that's the question we are asking. As I said, I've already alluded to this. This best applies to impact investing in private markets, and I'll fill in a few more details later. So private markets is the search frictions. Impact investing is going to be the preferences that we're going to give these investors, and I'll be specific in a second, which are going to reflect kind of intentionality and additionality, right? So these are going to be consequentialist type of investors that we're going to. So here are the four kind of insights to take away from this. So we're going to show that socially responsible investors are going to cause or can cause what we call strategic delay in reform. What does that mean? So this means that they're going to be entrepreneurs who would reform the firm immediately in the absence of any socially responsible investors, but they actually strategically decide not to reform in the presence of socially responsible investors. So in that sense, here, socially responsible investors can have a negative impact by making an entrepreneur switch from reforming the firm to not reforming the firm, causing delay in reform. And I'll spend quite a bit of time sort of convincing you of that result and showing you that result, and actually, in fact, in an example to make it sort of as clear as possible. So that's kind of one of the core results in that paper. Then we're going to show that making the market more pro-social, which you think that that should be a good thing in speeding up reform, can actually exacerbate this strategic delay in reform. Third, we show that there is a way of resolving this tension, which is what we call investment mandate. So this is when socially responsible investors can adopt particular investment practices and commit sort of ex ante to a particular type of trading behavior, if you wish, And what we're going to show is that there's an investment mandate with a greenium, which is you actually offer a premium for a green firm, so a firm that has already reduced externalities, and that can actually eliminate delay, and investors are willing to adopt this mandate. And then finally, we also highlight a second type of strategic delay, and this is what we call strategic delay in the sale of a dirty firm. So this is when the expectations of the market becoming more pro-social in the future, potentially. And the expectation of this can actually induce an entrepreneur to not sell a dirty firm to a socially responsible investor until the market becomes more pro-social, right? So the entrepreneur is going to meet impact investors in this market, but decide not to sell, to wait for the market to become more pro-social. And that's a strategic delay in the sale of the firm, which can actually lead to significant delay even in the absence of any search frictions, right? Because here the delay is going to be until the market is becoming more pro-social. So these are the four kind of key insights, and I'll show you the details in a little bit and provide some background. In terms of the literature, just very briefly, there's a theoretical literature on the impact that SRIs have on firm production decisions. When we started the project, the list was quite small. Now the list is becoming longer and longer, and this is certainly not comprehensive anymore. But here a few kind of central papers in this literature. And our paper really differs in that it studies how quickly SRIs can generate impact. So it's really about the timing of firm reform. We also contribute to the literature on decentralized financial markets, and there's a large literature out there. There's a nice survey by Pierre-Oliver Weil on this. And here the contribution is to introduce pro-social preferences into such a context. And in terms of the empirical literature, what maps most closely to what we do is social response investing in private markets, in particular private equity. And here, a number of papers that are also studying these types of questions, in particular in private equity. Here, there's a significant concern. This is a much smaller list compared with what you would know from the public markets literature, and that's largely because of data constraints on private market transactions. But there's a really fantastic initiative by a number of people, including Jessica Jeffers, who's also in this field, of also trying to kind of improve that and gather more data. All right, so let me tell you what I'm going to do. So I'm going to show you what we call an example. So in the paper, it's 2 pages. And these 2 pages will give you kind of the idea, sort of, shed light on this idea of strategic delay in reform. I'm going to show you that first. So that provides kind of all the kind of core intuition of this kind of main mechanism in the paper. I'm then going to show you what the general model looks like, and strategic delay is going to be conceptually really the same thing in this more general model. Then I'm going to introduce these investment mandates, which are going to be able to kind of address this issue of strategic delay. And then I'm going to talk about a few kind of additional implications and extensions that we've worked on. But I'm also very curious to hear the questions that you may have. So I'll certainly leave time at the end to hear what your thoughts are on this. All right, so here's the example. There are 2 periods, and there's no time discounting. And there's going to be a deep pocket entrepreneur who initially owns what we call a dirty firm. So what is a dirty firm? A dirty firm generates a profit pie and a social cost, and it's a high social cost at the end of each period, right? So period 0, period 1, so or first or second period. So deep pocket means, and that's really crucial, and that contrasts this paper with, for example, the Imco and Daub paper, there are no financial constraints, right? So the entrepreneur has no issue of, coming up, financing potential reforms or, transition of this firm. Let me also highlight that we call this social cost. In fact, in our model, this is also in contrast to some other papers in the literature, it doesn't matter whether this is a social cost or social benefit, right? So it could also be positive externalities. It really doesn't matter in our model. Okay, so we start with a dirty firm. What is reform in this firm? This entrepreneur can make the firm green by paying this cost kappa in this initial period, right? So you just pay a cost. And what does this cost do? We have the same profit of a green firm, but there's going to be a lower a lower social cost or a higher social benefit, right? So I'll not keep repeating kind of social cost or social benefit, right? It's just one that, you know, that's socially more desirable as a firm. And we're going to assume, of course, that it's going to be socially optimal to reform this firm, otherwise that wouldn't be interesting. But we are also going to assume that even in the second period, right, where there's only one period left, this is going to be socially desirable, right? So ideally, you want this to happen, of course, in the first period, right? Because then you reduce the social cost for 2 periods. But even if you end up in the second period, you still want to reform this firm. And then, crucially, preferences, right? So I always sort of say that the difference between a finance model and a sustainable finance model is social costs, that's one thing, and then preferences about social costs. So we want to have what we call broad pro-social preferences or consequentialist type of preferences. So if the entrepreneur owns the firm, then she enjoys the profits, right? So that's a private good. Well, that's going to be the public good component, which is the social cost, which could be high or low. And she's going to put some weight gamma on this. So this is just purely the pro-social preferences, the pro-social preference parameter of this entrepreneur. Now, so this is, pro-social, right? So a social cost enters the utility function. What is it? Why is it broad? It's broad because the entrepreneur cares about the social cost independent of ownership. So even if the entrepreneur doesn't own the firm, she's going to suffer a disutility from the social cost, right? So here you really fundamentally care about social costs. So this is consequentialist type of preferences where you worrying about the social cost of this firm doesn't depend on whether you own it or not, right? You care about social costs. And this is going to be important, and I'm going to show you in a minute why. All right, so that's the entrepreneur. Now, the entrepreneur will meet an investor at the beginning of the period 1, so the second period. And this investor can acquire a firm, and if it's a dirty firm, the investor can also reform this firm, right? So there's nothing special about the entrepreneur's technology. The entrepreneur can reform it, an investor can never reform it, right? So there's no particular advantage of anyone in terms of the cost kappa to reform the firm. We're going to compare 2 investors. We're going to start with a financial investor, and the financial investor that's finance 101. So that's how we used to think about finance, I guess. It's a financial investor who cares only about profits, right? So when the financial investor owns the firm, then he enjoys the profits. And if not, then the utility is simply zero, doesn't care about the firm. So this is a financial investor. And we're going to also think about and compare this to a socially responsible investor who also has broad pro-social preferences. Here, the only difference is that it's a different parameter. So here, the pro-social preference parameter is lambda. And importantly, he's going to, worry about the social cost independent of ownership. What matters, of course, is that this SRI kind of matters in this world. So we're going to assume that if the SRI acquires the firm and it's a dirty firm, then he actually reforms the firm. So the lambda needs to be high enough such that the utility gain from reform exceeds the cost of reform. All right, so think about this as an impact investor, right? So first of all, intentionality, there are pro-social preferences, right? So there's a lambda, a weight that we put on social cost. But this investor is going to also think about counterfactuals, right? Even if I don't own the firm, what is going to be the social cost being generated by the firm? And this is this famous additionality component of impact investing. You want to have an impact over and above what would have happened otherwise. That's the second part. So these preferences really capture this impact investing in private markets best in our view. So the entrepreneur is going to meet one of these investors and then can make a take it or leave it offer to sell the firm, and does not sell if indifferent. Right. So this is the model, very simple. Initially, the entrepreneur owns this dirty firm and can pay this cost kappa to reform. Then there's going to be production, so there's going to be some profit being generated, and then either a high or a low social cost, depending on whether the entrepreneur reforms the firm. There's going to be trading at the beginning of the second period, where the entrepreneur can sell the firm to an investor. And then if the investor acquires the firm, can pay, and it's dirty, of course, then can also pay the cost kappa to reform the firm, and we have a final production stage where there's a profit and a social cost being generated. Right? So this is the example. It's very, very simple. So let me talk you through the economics here. So let's start with a financial investor. Right? So it's a market. There's only one financial investor. So the entrepreneur is definitely going to meet this financial investor. And now we do some basic asset pricing. So we're going to kind of think about what is the investor's the willingness to pay of this investor for different types of firms. So let's say the entrepreneur has already reduced the social cost of production and therefore owns a green firm when she meets this financial investor. So what's the willingness to pay of this investor? We look on the right side. Well, if the investor doesn't own the firm, it's just a simply utility of 0. And then the utility, if the investor indeed acquires the firm, is just the difference between profits and the price that he pays for it. So very simply, the willingness to pay is simply the last period profit, right? So the investor is just going to own it for one period. So his willingness to pay is just for this final period profit. So now, does the entrepreneur want to sell at this price? And here, the answer is no. And the reason is that if the entrepreneur doesn't sell the firm, then she enjoys the profits and suffers from potentially the social cost that's generated still by this green firm or social benefit. But if she sells, then she can only sell at this price high. So the utility, as you see, is going to be identical, right? So here it really doesn't matter whether you pay for these profits, or in the more general model is discounted profits, or you keep it. So per our convention, the entrepreneur does not sell the firm, right? So there's no trading if the entrepreneur owns a green firm and meets a financial investor. Okay, so let's make the firm dirty. So now it's still the financial investor, but now the entrepreneur decided not to reform the firm, so it's a dirty firm. Now, if we think about the willingness to pay of the investor, it's going to be identical. The investor doesn't care about the social cost of production. Hence, the highest price he's willing to pay is just the last period profit. Now, does the entrepreneur want to sell? No. The answer is no, and it's the same reason that as in the case of a green firm, because the entrepreneur is concerned about the social cost of production independent of ownership, right? So by selling the firm, it's going to be a dirty firm, no matter what, whether you sell it or you retain ownership, and you can't really gain on the financial dimension, right? So whether you just enjoy the profits yourself or you sell it, at the price which reflects these profits, it doesn't matter. So there are no gains from trade, and the entrepreneur does not sell the firm if it's dirty. Okay, so this was the trading stage. So it's just moving backwards in time. So now let's think about the entrepreneur's reform decision. So the entrepreneur's reform decision anticipates that there's no trading with an FI, with a financial investor, in the second period. So now this entrepreneur is just going to compare the utility if she reforms the firm, which is simply owning a green firm for 2 periods minus the costs that she has to pay to reform it, and compares this to just owning a dirty firm for 2 periods, right? So it's just going to be the difference in the social cost and the reform cost. So this is very simple, of course, that now she reforms the firm if and only if the gamma is sufficiently high, right? So you need to be sufficiently pro-social to reform this firm. So it's very simple, right? So in some sense, now putting this financial investor benchmark is very, very stylized and very, very simple. They simply don't matter. You never trade with an FI in this benchmark. In fact, the same result would occur if there was no financial market to begin with, and you just operated in autarky, right? So that's kind of a benchmark that we can now use to compare what happens if the investor instead is a socially responsible investor. So now we consider a socially responsible investor, and we go through the same kind of asset pricing, thinking about a green and a dirty firm. We start with a green firm. Again, we think about the highest price that now a socially responsible investor is willing to pay for a green firm. If the investor buys the firm, then again, he gets the profits, pays some price P, and suffers from this potentially low social cost of production. Now, if he does not buy the firm, he still suffers from this social cost of production, right? Because these are consequentialist type preferences. Now, interestingly, if you now think about the highest price, you equate these two sides, the highest price, this SRI is willing to pay for a green firm is just profits. The reason being that whether or not you buy this firm, the social cost that's going to be generated by this firm is going to be identical. So really not impacting the social cost of production, so it shouldn't affect pricing. So that's interesting. So once you have consequentialist type preferences, typically we think about green investors willing to pay more, social response investors willing to pay more for a green firm. In many models, that's true. I'll come back to that. In this model, it's not. So if you're consequentialist, actually you wouldn't, right? So the impact investor would say, there's no additionality. Whether or not I buy this firm has no impact on the social cost generated by this firm, right? So there's sort of no point in buying this firm from that perspective. There's also no point here from the profit perspective, right? There's also no financial advantage. Therefore, there's no reason to buy. So does the entrepreneur want to sell to now an SRI? And given that the willingness to pay is only for profits, the answer is going to be identical to before. No, right? Because also the entrepreneur takes into account that the social cost of production is going to be incurred, or the cost of it, the disutility of it is going to be incurred independent of ownership. Okay, so green firm, no trading. That's the first piece. Now, I've kept you in suspense. Now, actually something interesting happens, and this is when the entrepreneur, in fact, owns a dirty firm. So now the investor is going to think, if I buy this firm, I again, benefit from the profits, I pay some price. I'm going to pay the cost. I'm going to reform this firm, so I'm going to pay the cost kappa, and therefore enjoy a low disutility from the low social cost of production CL. Importantly, the investor now thinks, well, if I don't buy this firm, the issue is that then the firm remains dirty, and then I'm going to suffer high disutility, because the social cost of production is in fact high. So here the counterfactual really matters. So what does it mean for the price? So what's the highest price this investor is willing to pay for a dirty firm? And it turns out, if you just equate these two sides, that the investor is willing to pay a premium for a dirty firm. So you see this piece here, the lambda times the change in the social cost of production minus the cost. And that's positive if and only if the investor is willing to reform the firm, right? So he's going to be a premium for a dirty firm if and only if the investor, in fact, has a preference for reforming this firm. And importantly, this is going to be driven by this concern about not acquiring this firm and this firm remaining dirty. So here, additionality really bites, right? You're really thinking that if I don't buy this firm, it's going to remain dirty. If I buy it, I can actually reform it and reduce the social cost of production. So here there's really additionality, but this additionality, in fact, induces a premium for a dirty firm. So that's really much, in contrast also to the models where, you're willing to pay more for a green firm. So in, by now, more standard asset pricing models, actually like Pastor, Stambo, and Taylor. And that's important because typically in these models, what we have is that investors are willing to pay more, green investors are willing to pay more for a green firm. So green firms actually have a higher price. In our model with consequentialist preferences, it's actually the opposite. So here, this induces a premium for dirty firms for the reason that you want to acquire and reform these firms. So it's really important to kind of take into account when we think about this debate about the cost of capital of green versus dirty firms. So here the implication of our model is very different. So does the entrepreneur want to sell at this price? And the answer is yes. And there are two reasons. First of all, if we just compare it in the matrix up here. So first of all, I can just retain ownership of the firm and enjoy profits, or I can actually sell it at a premium. That's good, right? So definitely that's a reason to sell. There's a second reason to sell, because if I don't sell it, the firm remains dirty. If I sell it, it's going to be reformed by this socially responsible investor. And that's also good for me as an entrepreneur if I have a positive karma, which means there are two sources of gains from trade in this situation. And the entrepreneur, in fact, sells a dirty firm to an SRI. Now, maybe you can already anticipate a little bit what's going to happen and where the strategic delay is going to come from. So let's now think about the reform decision of the socially responsible investor. The socially responsible investor is going to anticipate that she's going to trade with an SRI if and only if the firm actually remains dirty. So if she reforms the firm, then there's no trading, and she simply gets utility from owning a green firm, just as before with an FI. But if she does not reform the firm, then she anticipates that there's going to be a period where the firm remains dirty. But then in the second period, she can sell this dirty firm at a premium to an SRI, and the firm is reformed. So now this reform decision, if we compare these two payoffs, tells us that now the gamma at which the entrepreneur reforms the firm actually has to be much higher. It now has to exceed the lambda, which is higher compared to the previous threshold. So the key idea is here that the anticipation of these trading gains when you own a dirty firm that you wouldn't get if you have a green firm, of course, just increases the value of owning a dirty firm and therefore reduces, everything else equal, the entrepreneur's incentive to reform the firm, right? So here the problem is that although these socially responsible investors really want to do the right thing, and ex post they do, right? So they reform a firm. That's what impact investors at least say they do. They reform a firm, right? Ex ante is going to, induce the strategic behavior by entrepreneurs by keeping these firms dirty strategically. Now, this sounds, we use these words like, dirty and green, which sometimes is, it's a little bit confusing because people really think about like, oh, a dirty firm is like, an Exxon Mobil of the world. I guess we talk about private markets, so that, it's not a good example, but a firm that's really, polluting a lot. What really matters here, and I just want to repeat it, that, this can be positive impact, right? So this is really about leaving sort of impact on the table, right? So only if the SRI can still generate some impact, there's going to be a premium in the market for this type of firm. All right. So just to summarize, strategic delay, right? So this is the first insight of the paper. The entrepreneur is going to reform the firm immediately in the absence of an SRI, but strategically delays reform in the presence of an SRI if this gamma is in this intermediate region, right? So it's sufficiently high such that she would immediately reform if there was just an FI in the market, a financial investor, but lower than the SI's pro-social preference parameter, and then would not reform the firm in the presence of SI. So here, exchanging the financial investor by through a social response investor in this market actually generates kind of a negative impact. Of course, that's not the full picture because it may be that the gamma is very low to begin with, right? Such that the entrepreneur would never reform the firm, no matter what. And of course, here the presence of SRIs speeds up reform because the entrepreneur, if there was an FI, the firm would just remain dirty forever. And with a social response investor, at least at some point in the second period, the firm is going to be reformed. And of course, there's going to be, a trivial case where gamma is just so high that it also doesn't matter whether there's a socially responsive investor in the market. So the entrepreneur is just so pro-social such that she reforms just in any case, right? But here you see the sort of, trade-off, if you wish, or the mixed effect that socially responsive investors can potentially have in such a market. All right, so this is sort of the key kind of insight number one. So let me show you just the general model and just highlighting how this is different. Ultimately, kind of the key forces in the model are similar and the structure is very similar. So the environment is now an infinite horizon, a discrete type infinite horizon framework, and all agents are going to be risk neutral with some time discount factor that's common to them, which is beta. And now we have n deep pocket investors in the market, so not only one, but there can be any number of them. And there's going to be NF financial investors and NS socially responsible investors. So it can be only financial investors, only socially responsible investors, or a mixture of the two. And for simplicity, we assume that if an investor acquires the firm, then he's going to own the firm forever. That turns out not to be true. We have an extension in the current version of the paper, and we're moving to full retrading in a new version that we are working on. So this really doesn't matter. And the SRI, again, has a lambda, so that's the pro-social preference parameter of the social response investor, is sufficiently high such that he reforms the firm if he acquires a dirty firm. And there are going to be search frictions, which now amounts to some probabilities of meeting each type of investor. So the probability of meeting a financial investor is simply equal to the proportion of financial investors in the market, and the probability of meeting a socially responsible investor is equal to the proportion of socially responsible investors in the market. So you're just randomly meeting investors in this market. So standard random search. So here, let me just repeat strategic delay, what that looks like in this infinite horizon framework. And it's going to, of course, look identical conceptually, at least, to what we had before. So in this benchmark where we only have financial investors in the market, so the number of socially responsible investors is 0, the entrepreneur reforms the firm if and only if this gamma parameter is sufficiently high. And that's, I think that's like the outer key threshold, right? So it's just going to be depend on the difference in the social costs generated by a green and a dirty firm, and the cost that you pay, the one-time cost that you pay. And here we just have the discounting in the background. Now, if there are some some socially responsible investors in the financial market, so the number of socially responsible investors is positive, then the entrepreneur reforms the firm if and only if gamma exceeds this higher threshold, eta 2. Such that we get the strategic delay in reform, again, in this intermediate range of gammas, right? So if there's an entrepreneur with pro-social preference parameter that's in this intermediate region, then she reforms the firm immediately if there are only financial investors in the market, but actually does not reform the firm if there are socially responsible investors in the market. And it's again for the same reason. It's a strategic delay in reform, because SRIs here have a willingness to pay to reform dirty firms, but once it's green, they actually don't. In the background, there's actually an interesting hold-up problem that's generating this, right? There's a hold-up problem in public goods. The problem is that once the firm is green, right, and it's going to be green forever in our framework, there's no reversibility. Ex post, SRIs have no willingness to pay for it, right? Even though they enjoy some of the benefits from firm reform. So it's a hold-up type problem in this context. Okay, so the second insight was that that if we make the market more pro-social, this strategic delay actually can become worse. So what does it mean? What could it mean in this market for this market to become more pro-social? And there are two parameters, in fact. One is the lambda, which is how pro-social these investors are, and NS is the number of socially responsible investors. Now, the lower threshold doesn't depend on these parameters, but the higher threshold of the strategic delay region is increasing in lambda. So there's more strategic delay if lambda goes up, and it's in fact ambiguous function of the number of socially responsible investors. So let me give you the intuition. So an increase in lambda, this means SRIs, each SRI becomes more pro-social. So this effectively increases the gains from trade. So here it just means that SRIs have a higher willingness to pay to acquire a dirty firm. So higher prices just means that increases or strengthens the incentive to delay, right? So the entrepreneur has more to gain from keeping the firm dirty. So here the sign, the effect is clear. An increase in NS, so that's increasing the number of socially responsible investors. So we keep the numbers of investors in the market the same, and we effectively increase the proportion of SRIs, has an ambiguous effect. And the reason is that the first effect is that keeping prices the same, it just simply increases the probability of meeting an SRI, right? So if you're an entrepreneur and you're thinking, let me keep the firm dirty, if it's now more likely to meet a socially responsible investor, then your expected, gains of keeping the firm dirty is going to go up. It takes less time to sell your dirty firm at a premium to an SRI, and that of course strengthens the incentive to delay. There's a second effect, and that's an interesting effect in our framework, we think, is a free rider problem between socially responsible investors. So this free riding problem actually reduces the price that socially responsible investors are willing to pay for a dirty firm. And that, of course, is a force that weakens the incentive to delay. And either of these forces can dominate, which means the overall effect is ambiguous. So what is this free rider problem? Let me just mention it briefly. If there are more socially responsible investors in the market, then if a given socially responsible investor thinks about what happens if I don't acquire this dirty firm, how much should I be concerned about this? if there are more other socially responsive investors in the market, you actually become less concerned about this, right? Because the likelihood that another socially responsive investor acquires and reforms this firm goes up. So this is free riding across SRIs in acquiring and reforming this firm, which in equilibrium reduces the price that a given socially responsive investor is willing to pay. This is interesting because here, the free rider problem, which we typically think is a bad thing in the context of the provision of public goods, here it's a good thing because it reduces the price and therefore reduces strategic delay, right? So that's kind of an interesting feature of our model. All right, so let me summarize this whole first part in a picture, and then I'll talk a little bit briefly about the additional pieces, which were the investment mandates and the market becoming more pro-social in the future. So here's this is a picture where on the x-axis we have gamma. So this is how pro-social the entrepreneur is, and on the y-axis we have the expected delay if the entrepreneur in fact does not reform the firm, right? So this is sort of how long does it actually take for the firm to be reformed. So the blue line here is one where there are no socially responsive investors in the market. So this is the financial investor benchmark. And here we had that if gamma is low, right? So if the entrepreneur is not too pro-social, then the firm is never going to be reformed. So here the expected delay is infinite, right? So hard to see in this picture. If the entrepreneur is sufficiently pro-social and exceeds this alpha key threshold, this gamma, this eta 1, then she immediately reforms the firm, so there's no delay. So now what happens if we introduce a socially responsive investor? So this is the case where there's one. Here we see this mixed effect of socially responsive investors. On the one hand, it reduces this delay of the expected delay or the time it takes for this reform of a firm, of an entrepreneur who would never reform the firm anyway, right? So this is sort of the non-strategic delay. And here, these social responsive investors have a positive effect because they reduce the time it takes for a dirty firm to be reformed. But as you can see here in this region between eta 1 and eta 2, it has a negative effect by inducing the strategic delay in reform. So there were entrepreneurs that it would just reform the firm immediately in the absence of any social responsive investors, but now don't reform the firm in the presence of social responsive investors. So here delay increases. And then if indeed the more pro-social investors in the market increase the strategic delay region, then there's going to be, again, kind of a mixed effect because the strategic delay region increases. So there are more entrepreneurs who are going to not reform the firm and strategic delay. But of course, the time it takes for a given dirty firm to be reformed, in fact, goes down. All right, I have about 5 minutes left, so let me just highlight kind of the two additional pieces. First of all, investment mandates. It may seem strange in this market where we put investors in that have consequentialist preferences. So they're very, in some sense, very sophisticated socially responsive investors, and they really care about social costs per se, that things can go so dramatically wrong, which is they can actually have a negative impact by inducing strategic delay. So that may sound strange, and in a sense is true, as I will explain in a second. So what if we give them the ability to adopt what we call investment mandates before trading starts in the market? Which means that they can commit to kind of some trading protocol, some trading behavior ex ante before they enter the market and meet an entrepreneur. And we want to think about two different ones. Of course, here, if gamma is high enough, we don't need any investment mandates because there's always going to be reform. So we only need to kind of consider the cases where gamma is below that. So we first think about a standard exclusionary mandate where an SRIs can commit to not acquiring a firm, either a green and or a dirty firm. And here, this can sometimes work, but doesn't always work. The problem is that if gamma is in this region where there's this non-strategic delay, so the entrepreneur simply doesn't have strong enough pro-social preferences to reform the firm, then of course, such a mandate cannot do anything, right? Because a dirty firm, if you commit to not acquiring a dirty firm, it just simply actually makes things worse because it keeps the firm dirty forever, rather than you as an SRI, at least at some point, acquiring this firm. it can actually alleviate the strategic delay in reform. So in the strategic delay region, SRIs actually have an incentive to adopt such a mandate that commits them not to acquire dirty firms, and that eliminates the strategic delay. And the reason is very simple, right? So the problem was that there was a premium for dirty firms ex post, kind of an expulsion effect. So by committing not to buy any dirty firms, you can kind of get around this the strategic delay component. So here it sometimes works, not always, but what always works is what we call a price commitment investment mandate. And that's one where we allow SRIs to commit to a price for a green and or a dirty firm. And it turns out that what they want to adopt is an investment mandate that promises a price, pre-committed price for a green firm that's above the discounted profits. So it's a premium that they're offering for a green firm. Now, this is very intuitive. The problem initially was there was a premium for a dirty firm, but no premium for a green firm. And therefore, there's the strategic delay incentive. Of course, there's always going to be a high enough premium for a green firm such that the entrepreneur immediately wants to reform the firm to capture this premium. So that's not so interesting. What is interesting is that SRIs, in fact, have an incentive to adopt this mandate. And this is, without going into much detail here, is in fact an equilibrium object in our case. So it's a Nash equilibrium in the adoption of this mandate. So we require that no individual socially responsive investor has, in fact, ex ante an incentive to deviate from this mandate. And that's true. And the intuition here is that SRIs would rather pay a premium or commit to pay a premium for a green firm and therefore avoid the disutility that they suffer from a dirty firm, rather than paying a premium for a dirty firm ex post later while having to incur this disutility in the meantime. That's kind of the main intuition. So finally, there are a number of extensions and also some robustness work in the paper. Let me first mention this more pro-social investors in the future part. So here we have an extension where this lambda, so this is pro-social preference parameter of socially responsive investors, may jump up in the future. So there's a probability in each period that it jumps from a low level to a high level. And here we show that we can get the strategic delay in trading. So that was the fourth insight that we had. So you may want to wait as an entrepreneur who owns a dirty firm of selling your dirty firm to an SRI until the market has actually, in fact, become more pro-social, right? And that's another type of delay that can lengthen the green transition and extend it. We can introduce generalized Nash bargaining and show robustness to that, and there's some additional insights. We can vary the severity of search frictions. We can introduce retrading, which gives some intermediation role to financial investors. And then there are a number of additional insights that I don't have time to go into, but maybe there's some interest in the audience to talk about. So it speaks to a number of things. We have something to say about the political economy of climate regulation. For example, what if socially responsible capital is limited? How is this related to warm glow types of preferences that I alluded to earlier that are quite standard in some of the asset pricing literature that speaks more to public markets? So that's all in the paper. So let me conclude. So the starting point of this paper is really to think about what we think was the pace of firm reform, right? So really think about the timing of firm reform, which we think is important, of course, in light of climate change. These are the four key insights. There's strategic delay in reform induced by social responsible investing. This can be exacerbated, in fact, if the market becomes more pro-social. You can eliminate this delay by adopting this mandate with a greenium, and we can get strategic delay in trading if the market is expected to become more pro-social in the future. There's some implications, but perhaps I stop at this point and maybe fold this in if people have questions. I mentioned some of them, but we think that has, of course, implications for impact investing more narrowly, but also some of these broader implications on pricing go beyond the specific, perhaps, setting of impact investing in private markets. Thank you very much for your time.
Well, thank you so much, Jan. This was an incredibly interesting talk. The floor is now open to questions. If you want To ask your questions, please post them in the Q&A window. If you want to ask the question yourself, raise your hand and I'm going to unmute you. So there was already one question, Jan, maybe you could take that, and I'm going to unmute Christoph, who asked this question. And he can talk, he can ask the question
Can
himself.
you hear me?
Yeah, absolutely. Go for it.
Actually, maybe my question has already been answered on the last 3 slides or so. I don't know. But I'm just wondering, in general, when we think about this sustainable investing and all these discussions, there are at least 2 ways in which sustainable investors supposedly affect firms, right? So when you're studying this impact investing, this active decisions of management things, right? But of course, a lot of talk is about financial frictions and tightening financial frictions of firms or financial constraints and affecting firms through that, right? And instead of just changing firms to activist behavior. And I wonder how this might be incorporated here, or how this might go together with the channel that you study here. But you mentioned this search friction thing on one of the last slides. So maybe that's one way to do it, to think about this financial constraint channel through search frictions in this private market, making it harder for firms, for the entrepreneur to find somebody to sell the firm to, if it's brown or so, something like this. But I just wonder what your take on this is in this framework here.
Great, thanks, Christoph. Jan, can I ask a couple of questions as well, and then you can maybe answer all of them together? Okay, great. So one of the things I was wondering, and you sort of alluded to at the beginning, is that your analysis applies more to private markets. So maybe could you talk a little bit more about why private markets, and how would these results sort of also speak to other forms of financing, public markets or debt financing, for example? And the other question I had is, have you sort of thought about competition on the side of the entrepreneurs? So like if there are several entrepreneurs sort of fighting for capital, it's sort of kind of related to the financial constraints, I guess, a little bit. And so I guess, like, how do you think about if you sort of delay your investments in this period, how would that sort of affect the probability that you're able to actually find another socially responsible investor in the future? So sort of, do you sort of think about it in, you know, from the standpoint of having the costs of search increase over time? Like how do you think about these issues?
Great. Thank you very much. Great questions. So financial frictions, we don't have them in the paper, at least not in a very specific way that we think about them, right? Financial constraints, kind of at the firm or at the at a fund level, potentially. But you can introduce this a little bit into the paper, into the thinking of the paper. So what do we mean by financial constraints? Who is financially constrained? Is the entrepreneur financially constrained? So of course, if the entrepreneur is fully financially constrained and cannot finance any of the reform cost, then there's no strategic delay in reform, because the entrepreneur can never reform the firm anyway. But of course, what we think is true is that very few firms are completely financially constrained and cannot pay anything towards kind of the green transition. And in one of these, initial kind of in the discussion, what we show that in our framework, if the entrepreneur can only contribute to reforming maybe one step, let's say, right, and has some resources to pay towards the green transition, the same type of logic applies, right? That the entrepreneur doesn't want to kind of do this step that she could do, right, given her constraints, to reform the firm, because that reduces the premium effectively of selling a dirty firm. Now, it could also be that the socially responsible investors are financially constrained. So there's kind of some limited capital, right? So this, there's some additional facts that we can sort of think about. Of course, full kind of equilibrium analysis of this is beyond the scope of this paper. But it is sort of important, because if you think about financial, like impact investors being kind of financially constrained or somehow constrained in terms of the capital, then what they need to do is not only sort of acquire these firms and then reform them, but also sell them further down the line to kind of free up the capital to further, acquire and reform firms. So this would give rise to kind of an interesting role for financial investors who then kind of basically absorb, these now green firms that social response investors potentially could have reformed. But I also agree with your maybe sort of slightly broader interpretation, perhaps, of search frictions, of capturing at least some type of financial frictions more broadly in the market. And this connects a little bit to Ishita's point, second point, which is how do we think about competition between entrepreneurs, right? And one way of thinking about this is actually making kind of reducing the probability of an individual entrepreneur actually meeting an investor, right? So the market becomes kind of more tight, more crowded, and therefore, if there are more entrepreneurs competing for the socially responsible capital, it actually makes it less likely to meet one. So here the effect is actually twofold. It's interesting. The first effect is, as we show in the paper in this extension on the severity of search frictions, that the incentive to strategically delay reform goes down. And the intuition is very simple, right? If an entrepreneur, and it's just quite unlikely that I meet an SRI, right? Everything else equal, I'm less likely to strategically delay reform, right? It's going to take me a lot longer to sell this firm, even if there's a premium in the market, it may not be worth it, right? So it curbs the strategic delay incentives, but at the same time, if you still remain dirty, it will take a lot longer for a dirty firm to be acquired in the first place, right? So if I decide not to sell it, not to reform it, right? But now it takes, really ages to meet an SRI who then acquires and reform it, right? So the effect is kind of twofold. So that's sort of a way to think about competition and sort of maybe financial frictions more broadly connected to the first question. There's another way to think about competition, and that's this extension to generalized niche bargaining. So this is, here you can kind of vary effectively the bargaining power of the entrepreneur when selling the firm, right? And you can sort of think about, more competition between entrepreneurs as, reducing their market power, which you can capture by kind of a lower bargaining weight, right? That's how at least some of the literature kind of thinks about this. And here, this has a purely kind of positive effect on strategic delay, right? So if you have less bargaining power, that's going to induce like lower prices, right? So the price that you will get from a socially responsible investor is going to decline. So your strategic delay incentives come down, right? So these are two ways of thinking about competition in the market. Of course, one has to say that this really requires a full general equilibrium analysis with kind of free entry and, to model all these effects. Because once you have these effects, this also affects kind of entry decisions, and this will affect kind of the demand and supply for socially responsible capital. And then finally, perhaps on the last question on private markets. So in some sense, there's these search frictions and these preferences, they really just lend themselves as an application to private equity impact investing. And we think about frictional markets really as sort of, that's how we model private equity. So how does it go beyond that? Do we think that private debt may also, we could apply this to private debt? To some extent, right? So if you think about sustainability-linked types of instruments, right, that are also kind of trying to achieve impact in a private market setting, and banks, meeting firms, this was kind of a frictional process, so this may apply. Does it apply to public market impact investing? So here we don't have this in the paper yet, but we're working on sort of a little extension where we take this to kind of a standard blockholder model. And what you can show is that this really also applies, the same logic applies. So if there's a large blockholder with these types of broad pro-social preferences, the same type of strategic incentive arises, right? That you want to pay a premium, or sort of here you push up, the price for a dirty firm because you are worried about this firm remaining dirty if you don't acquire a large enough stake in the firm. Now, if we think about the cost of this, right? So the strategic behavior in a public market, it then depends on how long do you think it takes to acquire a stake in a firm and built a block in a particular firm in order to affect the decision? How does corporate governance work? How quickly does that materialize? I think these are sort of additional questions one would have to kind of think about in this context. But yes, I think the broader, general message here, I think applies more broadly. You are muted.
Yes, thanks so much. I was just saying thank you so much for those responses. There's one more comment on the chat, but in the interest of time, I'm just going to let you read it. It's more of a comment than a question. Ben, I'm sorry, I cannot get to your question in the interest of time. But thanks so much for raising it. And Jan, thanks again for taking the time to do this presentation. It's a fascinating paper and an equally fascinating presentation. And thank you so much, everyone, for joining us today, and look forward to your participation in future sessions as well.
Thank you so much to
so
the
much.
audience and also to Ishita. Thank you.